Hello, this is Jim Bell. I'm here with Matt King today, and we're happy to be hosting our webinar on managing your cash reserves in a no-yield environment. Thank you for joining us. In late 2009, we launched a strategy to help our clients manage their cash in what was and still is a no-yield environment. Most money markets and savings accounts yield next to nothing. Certificates of deposit don't offer much more. So how do you make your cash work for you in today's market? Today, we plan to share with you how we manage our clients' cash via our cash reserves management strategy. We'd love to receive questions during the presentation. You can submit those to us in the question box on your screen, and we'll leave time at the end to answer your questions. If you're having technical difficulties, if you can't see the screen or hear the audio, please submit those issues to us as a question as well, or you can call our office at 1-800-700-0089. Here's today's agenda in terms of what we'll cover. The current yield environment for cash yields, the true cost of money market funds, the risks of money market funds, differentiating between emergency reserves and excess cash, how much emergency reserves are enough, identifying appropriate investments for emergency reserves and excess cash reserves. And again, we'll leave time for your questions, so please submit those as we go along. I want to turn this over now to Matt King, our Chief Investment Officer and Chartered Financial Analyst, who designed this webinar today. So Matt, let's start by talking about what we mean by a no-yield environment.
Thank you, Jim. And the table on the screen here illustrates exactly what we mean by a no to low yield environment. All traditional cash equivalents yield either nothing in the case of 3-month or 6-month treasury bills, which yield 1 to 2 basis points, or next to nothing in the case of money markets and savings accounts, which have an overnight national average of 15 basis points, or CDs, which you're supposed to be paid a premium for locking up your money for a period of time, but that certainly isn't much of a premium, with 3-month CDs paying 16 basis points, 6-month CDs paying 24 basis points, and 1-year CDs paying 39 basis points. And based on the most recent statement from the Federal Reserve, who controls short-term rates, it's likely that these low yields are here to stay for a while, at least until mid-2013. Their most recent statement, which was released last week, reads, "The committee decided to keep the target range for the federal funds rate at 0 to 0.25% and currently anticipates that economic conditions, including low rates of resource utilization and a subdued outlook for inflation over the medium run, are likely to warrant exceptionally low levels for the federal funds rate at least through mid-2013, emphasis ours." And it's not just the low yields that should steer you away from money market funds. We're always surprised that for how cost-conscious most investors are these days, how few actually realize how much money market funds cost. Now, when money market funds pay 4 to 5%, like they did a number of years ago, these costs aren't very noticeable, and the price is worth the convenience, liquidity, and safety that they provide. But at today's low yields, or no yields, money market funds are just downright expensive, and basically the brokerages who offer money market funds are taking the entire yield, whatever there is, for themselves via their management fees. So while money market funds are great for liquidity and convenience, it's appropriate at this time to look for alternatives. And it's not just the cost of money market funds that's an issue. There are risks to them as well. The biggest risk to money market funds as well as other low-yielding cash investments, is inflation. And granted, this is a very long-term risk, but it's still a significant one. Now, whether you look at the current inflation rate, which is 3.8% year over year as of August 31st, or the long-term average of 3.1%, cash equivalents pay nowhere near the yield necessary to maintain your purchasing power. That means at current rates, your cash is losing 3 to 4% of its value per year. There's also other risks. Unbeknownst to many investors, many money market funds have invested heavily in Europe in an effort to capture higher yields, as rates in Europe are higher than they are here. As a result, many money market funds have exposure to European banks. According to the Financial Times, the 10 largest U.S. money market funds had 47% of their assets in European banks at the end of July. And the European banks, in turn, have high exposure to the sovereign debt of countries like Greece, Portugal, Italy, Ireland, and Spain, who have obviously been making news in the past 18 months due to their weak financial condition. Now, we're not suggesting that there's going to be some massive European credit crisis that's going to threaten the European banks and force U.S. money funds to break the buck, but the probability of such an event is not zero. And as we know, as investors, we shouldn't accept any risk that doesn't come with a reward. And at basically 0% yields, there is no rewards with money market funds today, which is why a couple of months ago we moved our clients out of general diversified money market funds, which have European bank exposure, to U.S. Treasury, government, or muni funds that don't. So what do we do in an environment like this? What are the alternatives? Well, we have to think outside the box a little bit and manage cash in a bit of a non-traditional way. The first part of our cash reserves management strategy is to divide our clients' cash into one of two buckets. And this is because not all cash has the same purpose. The first bucket is cash for emergencies. Now, this is either replacement income. If you're working, that means income in the event of a job loss. Or if you're retired, income in the event of a decline in your portfolio during a bear market. It's also there for unexpected events, whether that's a new roof on the house or a bigger tax bill than expected. Any cash above and beyond that is what we've deemed excess cash, and that goes into the second bucket. Again, this is cash that exceeds the amount needed to cover emergencies or replacement income for a period of time. Really, this is just cash that provides peace of mind. It's cash that our clients are not quite ready to put at risk in the stock market. Because there are two different types of cash, there are two different strategies for managing each of them. With the emergency cash, the timing and the amount of your liability is unknown. You don't know when you're going to lose your job or when a tree will fall on your roof. So that cash needs to be safe, liquid, and accessible at all times. Yield is a secondary priority here. So typically we recommend sticking with investments like money markets, savings accounts, and treasury bills. However, as discussed, in today's environment, those aren't very good options. So we're recommending online savings accounts for our clients' emergency cash, and we'll discuss those in more detail in a moment. As for the excess cash, you still need to keep this low risk, but there aren't the same liquidity restraints as with the emergency cash investments. Therefore, you can invest these monies for longer periods of time to help maximize your yield. Traditionally, CDs fit the bill here, but as shown earlier, the yields on CDs at present don't justify the fact that your money is locked up and inaccessible, and we've stopped recommending CDs to our clients as a result. Instead, we're recommending short to intermediate term bond funds for our clients' excess cash, and we'll go on into more details on those in a moment as well. But first, let's circle back to the online savings accounts that we're recommending for our clients' emergency reserves. As their name implies, these are savings accounts offered by online banks. These banks don't have branches, so they have less overhead, which means that they can afford to pay higher yields than traditional banks. These accounts electronically link to an existing checking, savings, or brokerage account, even one that's at a different institution. They are FDIC insured up to $250,000 like everything else. And like all savings accounts, federal regulations limit withdrawals to 6 per calendar month. So you can't exactly use this like a checking account, but there certainly is some ability to move money. There are no limits on deposits. Now, some examples of these online savings accounts, and you may have heard of some of these, include the ING Orange Savings Account, the American Express High Yield Savings Account, and the Ally Bank Online Savings Account. And as you can see on the screen there, 1% yields are a significant pickup over what traditional savings and money market accounts are paying these days, 15 basis points on average. With the emergency cash strategy, we start by helping our clients figure out the optimal amount of emergency cash reserves for their specific situation. That amount varies based on each individual's situation, but typically that translates to 6 months to 2 years worth of core living expenses. Now, by core living expenses, we mean your baseline non-discretionary expenses that you absolutely have to pay. The mortgage, the car payments, utility bills, grocery shopping budget, kids' school tuition, etc. It doesn't include discretionary spending items like fancy vacations or nice restaurants. The idea is that you would only spend what is minimally necessary in the event of an unexpected event like a job loss. Now, there are a number of factors that we take into account when determining the appropriate level of emergency cash reserves. If you're working, job security. How likely is it that you or your spouse may lose your job? How long would it take you to find a new job if you were laid off? Perhaps you work in a very specialized field where it wouldn't take long, or perhaps you would anticipate a more extended unemployment. How much flexibility do you have in your budget? Could you quickly cut back to core living expenses if you were laid off, or if the value of your portfolio dropped? Or are your expenses largely fixed? What other sources of income are there? Is there a pension or a severance package that would kick in the event of a job loss? How liquid are your assets? How quickly can you liquidate your assets to generate income? Now, if your portfolio is real estate heavy, you may need to have some more cash on hand. From a planning perspective, required rate of return is a big factor. Cash is always a low-yielding asset. It's as low-yielding as it gets today. So it's a drag on returns. How much, what percentage of cash in your portfolio can you afford to keep before it starts to negatively impact your required rate of return and your retirement plan? Risk tolerance is another important factor that goes into this. Some people just feel more comfortable with cash on hand. We might recommend 1 year in a particular case, but the client may feel more comfortable with 2. If that helps them to keep their other assets invested for growth and helps them sleep at night, then that's certainly something we want to take into consideration. Now, once we've established this emergency cash reserve of 6 months to 2 years in online savings accounts, we can assess how much excess cash our clients have. Again, this is money that is not needed in the near term, but is not appropriate for stock or risk investments because the client is unwilling to take the risk, or because they may need this money in a couple years and don't have the necessary long-term time horizon to invest in stocks. For this excess cash, we are utilizing short to intermediate fixed income funds. Now, it's important to note that these are no-load funds. At today's yields, there's no sense in paying a load. It would take you a couple years to earn that back. While using these types of funds involves additional risk over money markets, CDs, and savings accounts, we view this risk as warranted and justified given the significant pickup in yield that we can achieve with these bond funds over cash equivalents. We're managing risk by focusing on managers and strategies with a demonstrated history of being able to protect capital even in environments that are hostile to bonds, like inflationary and rising rate environments. And we're currently using funds that are appropriate for investments or time horizons of anywhere from 6 months to 3 years. Each of these funds possesses a yield of at least 1%, and of course, there's the possibility for capital appreciation as well. And because these are all publicly traded mutual funds, all have one-day liquidity, which means we can sell before 4 o'clock Eastern on any given day and have your money available to you the next business day. And there are both taxable and tax-free options. As for the fixed income strategy that we're using, the fixed income markets can be characterized by low yields and what I would call rising or building yield pressures, which is the least favorable conditions for bonds. Obviously, rates have been on the decline with the recent panic in the financial markets, but rates are about as low as they can get, near historical lows. So certainly the longer-term trend is up, not down. Combine that with rising inflation expectations, and we want to take a defensive approach to fixed income investing. Within our fixed income funds, we are staying short to intermediate in terms of duration, using funds with a duration of 5 years or less. And we want to underweight treasuries, which we view as being the most exposed to rising rates because they are so close to historical lows. In lieu of treasuries, we're emphasizing what we call spread products, or bonds that have an interest rate that trade at a spread above treasuries because they carry more risk. Now, these types of bonds are corporates or emerging market bonds or muni bonds. We view these bonds as being less exposed to interest rate risk than treasuries. And while they carry a greater risk of default, we're more concerned with interest rate risk at this time than default risk. Lastly, we continue to view muni bonds as a very solid option for investors in the mid to high income tax brackets. On the screen here, you'll see the short-term past performance history of our cash reserve strategy. Again, we started this strategy in late 2009 and began measuring its performance the first day of 2010. And when you look at these numbers, this is exactly why we say the risk of investing excess cash in short to intermediate term bond funds is worth the risk. From the start of 2010 until the end of the second quarter, the clients who were invested in our fixed income strategy earned over 6% annualized net of fees. That's our fees as well as the mutual fund fees and trading costs. Now compare that to what they would have earned with risk-free cash equivalent assets, and you can easily see the opportunity here. This strategy puts your cash in a position to work for you by giving it a chance to at least keep pace with inflation so that you don't lose purchasing power over time. And certainly there are additional risks, but you can mitigate those to an extent by establishing a safe and liquid emergency reserve and by sticking with a conservative fixed income strategy, which has been our stance since we rolled out this strategy in late 2009.
Thanks a lot, Matt. This concludes the formal part of our presentation. A recorded version of today's webinar will be available on our website within a week. Additionally, all of our past webinars are available also on our website, although only clients can access our quarterly investment committee updates. Next month, please join us on Wednesday, October 19th at 2 p.m. to hear our presentation on the logistics of retirement, which will explain how we structure income-producing portfolios for our retired clients, and we'll cover other relevant issues as well. We do have some time for your questions, so I'm going to turn this back over to Matt at this time. Matt, I see the first question that's come in is, Can you provide some examples of specific bond funds that you're using as part of the cash reserve strategy?
We'd be happy to, but we can't do that within the course of this webinar. If you are a client and you wish to know, please email us at info@bellinvest.com, and we can certainly provide you that list. If you're not a client, you can contact us and schedule an appointment to meet or discuss this over the phone, and we'd be happy to share it with you then. It's just that without knowing your financial situation and tolerance for risk, we simply just can't recommend a fund to you without knowing that it is suitable for your portfolio.
Thanks, Matt. Before we go to the second question, I just want to also let our listeners know that if we don't answer your question specifically, we will get back to you with an answer. So don't hesitate to submit those questions. Second question, with interest rates at apparent lows, is it prudent to be investing in bond funds at this time?
Yeah, rising rates, or at least the potential for rising rates, are a definite risk. But as we discussed during the webinar, you can structure the bond portfolio to be in a good position to deal with that scenario. And that's why we're staying with a duration of less than 5 years at the most, and why we're underweighting treasuries, which we view as the most overvalued bond right now and the most susceptible to rising rates. Also, you can stress test managers and strategies by going back in history to see how they fared during previous periods of rising rates. And without a demonstrated history of being able to protect capital in rising rates, we don't add a fund or a manager to our fixed income fund list.
Next question is, what do you charge for cash reserves strategy?
The fees range from 25 basis points to 50 basis points per year, and the exact rate depends on the total assets you have with us under management. But we just charge on the excess cash portion where we are using bond funds. That's really the only place we can add any value through management. We certainly don't charge anything on the portion of emergency reserves that our clients hold in online savings account. We're happy to make some recommendations there, but certainly there's not much value we can add to a savings account.
Okay, thank you very much for submitting those questions. You don't need to wait for our monthly webinar or letters to stay in touch with Bell Investment Advisors. We update our website with new content regularly, and we post daily market updates on Twitter. Also, Bonnie Bell has a new blog focusing on career and life coaching issues. You can find that at careerlifecoaching.bellinvest.com. And as always, if you have a question about your portfolio, please don't hesitate to contact us by email or phone. Lastly, the slides in today's presentation are available upon request, so just let us know and we can send those out to you electronically. Thank you very much for joining us today. We hope that you'll join us next month as well. Goodbye.